460, engineering economy. We'll be talking about depreciation.
Hello everyone. Let me first introduce our team number 3. We have Daniel, Eduardo, and Dongbing, and I'm Tawfiq. Today we're going to talk about depreciation. We want to explain to you what is exactly depreciation and what are the available definition for this term, and then we're going to talk about different methods of how to calculate depreciation, and we'll give we try to come up with a single example and try to use different methods so you can compare like the methodologies and differences between the method to calculate the depreciation. And then we will talk about how depreciation is accounted and how they're accounted and taken into consideration when calculating and accounting taxes. So the ANSI, the American National Standardization Institute, gave a couple of definitions, but they define it as the decline in the value of a capitalized asset. So the value of a machine or of equipment or whatever assets do you have, it kind of, the value of it kind of declines with time, as you can see. But there is either also due to a loss of value due to physical or economic reasons, like the use of the machine or equipment, for example. And here we have an example for things that cannot depreciate. For example, he says, sorry, you cannot claim depreciation on your wife. And of course, it keeps declining with time, except that it cannot go below the salvage value. And we will explain to you in the examples how is that. And why we talk about depreciation? Why is it important? It's important because it is important in calculating tax. They deal with it as if it is an expense. It's depreciation actually is called a non-cash expense. And here, as I said at the beginning, we're going to represent an example. And we're going to talk about different methods of calculating the depreciation, but here we want to use only one example. That is on campus, in any research group, that you will need sometime a machine or an equipment. Here we have a scanning electron microscope, for example, and we want to find out like the feasibility study, or you want to know how much, whether you buy one or how long you want to keep it. So you want to know how does the value of this equipment or machine, and here is the microscope, depreciate. I'll give the chance to Eduardo to talk more about the first method.
Well, actually, I'd like to jump in. So the whole point of this is you're in engineering economy. You want to use this as a tangible thing, so you're part of a research group here. Your research group orders this machine at the cost of $150,000 in January. And it has a usable life of 5 years and a salvage value of $30,000. So we're going to use those numbers and the different methods of calculating depreciation to show how that actually breaks down and how much it depreciates each year based on what method. And I'll let Eduardo talk.
The first set of methods that we'll be discussing are the classical methods, and they are the straight line method, the declining balance method, and the sum of the years digits method. They're called the classical methods because they were used with the tax code if the equipment was placed into service before 1981. Now, the straight line depreciation method is the simplest and the most often used method to compute depreciation. It's very simple. The depreciation is given by the equation on the slide. You first of all, you take the initial cost of your equipment, you subtract the salvage value, and then you divide by the number of years that you expect for it to be in service. And it gives you an even distribution of depreciation during the entire service life of your equipment. For example, in our example, we said, well, our equipment costs $150,000, and it has a salvage value of $30,000 and a service life of 5 years. Now, to calculate the depreciation per year, you simply subtract $30,000 from $150,000 and divide by 5.
Sorry, we have to fix some technical tabs. But continuing off where you left off.
Yeah, if you divide by 5, you end up with $24,000 per year. Now, at the bottom, you can see the book value, or how much your asset is worth at the end of each and every year. Now, we can see that at the end of the first year, your asset is only worth now $126,000. And if you keep reading all the way down to the end of the service life, you'll actually find that your asset is worth its salvage value in this method at the end of the service life.
Okay, now we'll jump into a different method for accounting for depreciation. Now, this is a more realistic method because it's an accelerated method of accounting for depreciation, meaning that most of the value of the asset is lost with its first initial use or first initial years. You drive a car off the lot, immediately the price goes down. This is somewhat like that in the sense is the earliest years have the most depreciation in its value. The declining balance method is shown right here. You have this depreciation rate, A, and you multiply that by the book value of the year before to find how much it depreciates. And you use that new depreciation value to calculate the new book value, and then continue going on calculating depreciation, book value, until there's no more. Now, we changed the previous example just a little bit to make it a little bit more complicated. We said for this problem now that you buy the machine in April, so you don't have the full first year of it depreciating, you only have it depreciating 3/4 of the year. And you also have it depreciating at 200% the declining balance method. And we'll go through how to work this problem out. So like I said, I explained it here. Here's the depreciation rate. Since it's 200% the normal rate, you have the 200% divided by the useful life here, which is 5 years, giving you an overall depreciation of 0.4. Now, we use this 0.4, like I explained earlier, and you only have it for the first 3/4 of depreciation. So that's shown in this first depreciation value. This is how much depreciates, and your first initial book value is shown here, where you take the initial cost of the asset and then subtract the depreciation, and continuing so on and so forth. You can see, though, it worked out all the way to here. However, when we reach this value, book value of like 22,680, that's technically less than the salvage value. So what happens here? Any guesses? This actually can't happen, and I'll show you in the next slide. The actual depreciation in year 4 would only be $7,800, because that would take the depreciation of the asset back to its original salvage value. And so technically during the 5th year, you would have no depreciation of the asset. It just pans off on a straight line as long as, like, however many years you have the machine before that time, it can't depreciate less than the salvage value. So that's what it worked like. So you have the book value explains equals salvage value after n periods or whatever. You can't go less than the salvage value, just reinforcing that fact. And we have a funny comic here saying that Sarah Palin's book cannot depreciate more than it already has. So just going in that theme. Next slide. Another method of accounting for like an accelerated method of depreciation is the sum of years digits method. And it's similar to like by how much it depreciates in the initial years. It's based off of the asset losing much of its value in the first first years of use, just like the declining balance method, but it's formed a little bit differently. You use the sum of years digit, which is the SYD, which is shown here, and that's just, you're essentially summing the entire years of the useful life together. And a simple shortcut is you take the useful life, multiply by the useful life plus 1 divided by 2. And we'll actually show you how that's worked out very shortly. But as you can see, the depreciation in year J is given by this formula, where you have very similar notation to the previous problems that were shown. You have the book value minus the salvage value, but the percentage of depreciation lost is based off of the fraction created by the useful life and the sum of years digit. Next slide, please. Again, we just went to the normal standard problem of our scanning electron microscope being bought at $150,000. And we have the same salvage value of $30,000 and the useful life of 5 years. Now, showing you how to calculate the sum of years digits method, you just have 5 plus 1, 5 plus 2, that's 15. Now, as you can see, as the depreciation is calculated, you have that fraction before you have the actual calculation of what it seems like the book value of that section would be. So you have this fraction multiplied with the initial cost minus the salvage value, and you get the individual depreciation each year. Now, it's depreciating by like the same factor, but it's not evenly spread out through the entire useful life like the straight line method of depreciation. So this again accounts for the accelerated depreciation of most objects or assets in life. And I'll turn it over to Dominic.
All right. Okay, besides all these three kinds of classical method for calculating the depreciation, there are other kinds of methods. The first one is the thinking fund method. We can clearly see that in the previous discussion by Daniel, the balancing declining method and the SVD method, they all have a very common phenomenon, is that the depreciation happening in the early year is relatively larger than the ones happening in the later years of the entire service life. But here, the thinking fund is a totally opposite thing, that the depreciation happening in the early time is less than that happened later. This method is established by assuming imaginary deposit with a predetermined interest rate of IS. And we assume the total amount of this deposit is equals to your initial cost minus the salvage title, which means we just imagine all of these depreciation, the total amount of depreciation happened as uniform depreciation during the service years. So we can come with this equation to calculate the depreciation for a certain year. It's just like the depreciation equals to the sinking fund, which is little d, times the 1 plus the interest rate. And d is calculated as this, just like we know the total amount as the uniform depreciation, and then we know the years, we know the interest rate, so that we can use this formula to calculate d. So it's just like you can tell yourself, I'm not losing the value of the machine, I'm just depositing it into a progress banking account as a donation. Here we give a same example of how to calculate the depreciation with the thinking fund method. These values are the same as previously discussed, and we just imagine that the predetermined interest rate is 10% per year. So first of all, we can calculate the thinking fund. Little d is as shown as here. So it's come up with 19,650. And then, based on the equation, we can calculate the depreciation by, I'm sorry, this is 3, 4, and 5. I'm sorry, it's on top. We can calculate the depreciation in each particular year. As we can see, the depreciation increases with year goes by. So it's a totally opposite situation when we considering the interesting rate. And another method is called the unit of production method. In this method, another very important factor is considered is just like the total output of the through the whole service years. For example, if you are using machine, the machine has its own output. For example, if we use SEM for research, we take scans. So the total amount of the scans we take with the machine, in other words, the total usage of this machine should be considered. So in this formula, we can see the depreciation is defined by the proportion to the number of units produced in that period. That means the more scan you take with this machine, the more value I will lose. Okay, this is the same examples. See here, we just gave out these. Imagine this total number of scans taken each year, and we know the portions of these of the scans taken each year with the total amount. So we can calculate the depreciation by the formulas we showed. In this example, the very important thing is the scans or the output taken by each year should be known so that we can use this method. Besides of these three classical methods and the two methods I have introduced, there are other methods for calculating depreciation, since the tax code in the government is changing all the time. So after 1981, these two methods are introduced for calculating the depreciation. One is called the ACRS and one is called the IMACRS, which is simply for the modified ACRS. And in these two methods, since the tax code is becoming more complicated, so it's impossible for us to using such a simple formula to simply calculate the depreciation happening each year. So the rate of depreciation in both of these two methods is offered by the government based on different kinds of property lifetime and property type. So it's very simple. You have a property, you know its service life. You just go to the table and find out what the depreciation rate you should have and calculate depreciation. So from now on, no more calculation. All the things is given by law.
Well, now that we've gone over how to calculate, how to put a dollar sign to depreciation, we can actually see how it is applied to a balance sheet. Suppose that USC makes $100,000 gross off the use of the scanning electron microscope. If we go back to our first example with the straight line depreciation, if you recall, the microscope depreciated by $24,000 every year. Now the important thing to note about depreciation is that it's a tax deductible. Now what that means is that instead of being taxed at 35% from $100,000, we can deduct the depreciation as an expense, and we'll only be taxed at $76,000. What that means is that the taxes at 35% are not $35,000. In actuality, they are $26,600. Now, what that means is that your net income would turn out to be $73,400.
All right, guys, to sum up, we've noticed that depreciation is a money amount that affects the taxes and taken out from the actual, like the revenue. So to calculate the taxes, it's just taken out and then it's non-taxable. It's considered as an expense, non-cash expense. And also we saw that the depreciation cannot go below the salvage value. Perfect. Thank you very much. Do you have any questions?